Okay, so you're still forecasting, it's interesting, this chart, your forecast of around about $800 million turnover this year. So, I mean, where will the stock come from? We've seen the A-REITs obviously selling, being net sellers predominantly in the last 2 years, the key net seller. Who do you think will be the sellers in the year ahead?
Yeah, I think 2012 will be the year of trying to find the stock. I think it's, you know, you can see that the last couple of years have been pretty standout years. I mean, you sort of got to go back to 2005 to see a year even close to what we experienced in 2010 or even 2011. So, you know, those years or the last couple of years have been boosted by some pretty big activity, you know, but particularly by the likes of CPA. So that sort of helped the numbers. But I think this year we're going to see a real lack of high quality supply. So that's going to be, as a result of that, we're going to see a lot more secondary stock come to the market, and probably along with that more off-market activity to drive sort of investment, because there's that demand there, and people are still going to want to be investing in Melbourne. So I think that's what's going to drive it, and we're going to see sort of a more on average trend of activity through Melbourne this year.
Okay, so more sort of type of brokerage deals, maybe more part sales
as well?
Yep.
Mm-hmm. Yep.
Okay, perhaps more selective deal doing this year.
Yeah, that's right. I mean, but the counterpoint to that, I guess, is that if you were to put a high quality asset, you know, like a 452 that we had last year, you know, there's evidence to say that it would be chased really, really, really hard. I guess we're just not seeing that activity from at the vendor level coming through to supply that.
Okay, so one of the issues that Nick raised, and there's a very common theme this morning, is the lack of debt being used in the local markets. Do you see that as being a sort of tempering influence on the investment markets this year?
It's a topic that comes up quite often, but it's really it's a have and a have not sort of scenario when it comes to debt. I think if you're a good sponsor or you've got a good asset, from the feedback we're getting from certainly talking to the banks and investors that are talking to the banks, that's sort of where it sits. If you're the opposite to that, yeah, it's going to struggle. It's a more difficult environment to get debt. You know, much like, you know, Nick was talking about before with the demand for core assets, and I guess, you know, I talked about earlier, the same seems to apply, at least from our conversations with banks as well. You know, banks are after high quality core assets, and if you're after that or you're a high quality core sponsor, it doesn't seem to be a problem. It's not an issue that we've come across, certainly in the last 18 months.
So does it mean that there'll be any scope into the secondary markets with investors starting to move down to secondary? I mean, the theme seems to be the stick to prime up until now, but if the stock is not available at that level, do you think refurbished buildings will become more popular for investors? Yeah,
it's sort of been a topic that's least talked about, the secondary stock, the B-grade stock. It's certainly a much hotter market in core, and it's sort of left behind that B-grade space, and what that's meant is that the margin between the core buildings and the secondary buildings is spread quite a lot. So there's a real suggestion, I think, now that you can make some good money in that B-grade space. We're seeing a really, really tight vacancy sort of environment for prime, for A-grade and premium assets. So as a result of that, and you look historically, you tend to get a lot of growth through B-grade. It sort of lags it, but follows the really high quality stock. So our suggestion is that space is going to start to kick, and I think because the yields haven't kicked in that space as well, you can have some confidence about, you know, potentially getting some tightening in terminal yields when you come to exit as well.
Okay, so you think the timing, you know, 2012 is good timing to get into the secondary market?
Yeah. Yep, I do.
Okay. All right, any sort of particular takeout points for 2012 in terms of the outlook and opportunities for our clients in the marketplace?
I guess sort of 3 points that spring to mind is that I think the development environment is still quite difficult. So as a buyer, you can really settle up next to some developers and create the solution for them, if you like, and that's a good way to get some high quality stock. I mean, it's not sort of a new initiative by any stretch of the imagination, but it's particularly pertinent at the moment when you talk about debt, because that space is more difficult to get into. B-grade, as I talked about, another area where there's some real value at the moment, and also, you know, speaking about the lack of opportunity and sort of a more brokerage environment, that brings into focus, you know, sort of some more legislative things like beaks and the need to have those, you know, ready on your building so that you can respond to to what you might see as a premium offer, a premium pricing for your asset or an off-market situation. If you don't have that, you can't respond to it. You know, it's just a sort of an unhealthy scenario.
Yep. Okay, good. All right, well, let's now move on to an allied area of yours, to the office leasing market, pretty important one for particularly for 2012. Chaz Keogh is the new kid on the block. Chaz, this is your first panel discussion. Why don't you tell us a bit about, start with who you are, how you got here. Tell us a bit about your team for the year ahead and your plans in office leasing.
So I've just ticked over 10 years in agency with a particular focus on office services. I've got a broader regional perspective as I've worked on the west coast, the east coast of Australia, and more recently spent the last 3 years in New Zealand running the office services department over there. And it's clear from a number of conversations that I've had with clients since I've arrived that the Melbourne market's looking for greater choice in that high quality agency services. Some recent changes in the team have provided us with a great opportunity to build and reinvigorate an already strong performing team. We're bringing a fresh set of eyes to the process, and we're keen to roll up our sleeves and get stuck in and really add that true value from an agency services point of view to our clients. And that will be driven from the top down and the bottom up.
Okay, excellent. So you've got your feet out onto Collins Street and started walking the walk. How are you feeling the market so far this year in terms of tenant inquiry, types of industries, sizes? Give us your insights into the market so far in 2012.
Well, I think as a broader team, we believe we've sort of come out of a slightly drawn-out Christmas period. That said, and similar to what Nick referred to earlier in the presentation, I believe those tenants that have decision makers based locally or throughout Asia are going to be more active than their American and European counterparts. I believe tenants are still going to be very much focused on value or very value driven but less dollar driven going forward. I think that will then see a flow on effect into that lower end of the prime market. That being said, we've also yet to see the true benefits of around 165,000 square metres of tenant consultant briefs that hit the market last year that are still yet to make a decision. So that's exciting going forward for 2012.
Mm-hmm. Yeah, that's indeed on this chart. 74 briefs yet to decide, so there's still a lot of hangover, and that's really what I was saying earlier about not necessarily having a reliance this year on organic growth in employment leading to organic net absorption, but rather working with the existing base of tenants who want to move around and perhaps relocate. So what are the leasing strategies then for the year ahead, given the tough environment? And how would you be approaching your job?
Well, I definitely don't think it's really a new strategy. It's probably just a return to fundamentals about creating those opportunities, being resourceful, uncovering deals that are there. From a landlord's perspective, it's about being in the right place to take advantage of those opportunities that are presented, and that whether that be proactively repositioning assets or vacancies. I think that's part of the process going forward.
Yep. So we talked a lot about rents, perhaps not quite hitting the mark. How do you see, from your perspective as an office leasing negotiator, how do you think the rent growth situation will pan out in 2012, and also what will incentives do?